Welcome to The Explainer. Today we're unpacking capital dynamics. Whenever you look at a massive enterprise, do you ever stop and wonder how they actually structured their initial capital stack to get off the ground? It's really rarely just a rich founder writing a blank check.
Seriously, how do businesses actually secure millions to launch or scale? We usually only see the final product, right? The slick tech unicorn or the bustling e-commerce empire. But the financial engineering operating behind the scenes, that is the true engine of that growth.
Because here's the absolute truth of the business world. Not every successful company begins with a deeply pocketed founder. In fact, most definitely don't. The vast majority of businesses rely on different types of external financing to build that initial runway and basically bridge the gap to profitability.
So let's get into Section 1, Fueling Your Business Idea.
Whenever a business needs capital, founders are fundamentally forced into a crossroads. You've got debt financing on one side and equity financing on the other. And honestly, every single successful capitalization strategy has to navigate this exact intersection.
Let's start with the first route. Section 2, Debt, Borrowing with Interest. So debt financing is really all about leverage and the cost of capital. You secure a lump sum of liquidity immediately, but you enter an ironclad agreement to repay it over a set period of time, plus interest.
Pretty straightforward, right?
But debt isn't just a monolith. You have your classic bank loans and flexible lines of credit for working capital, business cards for those smaller operating expenses, and of course, specialized equipment loans. Because, let's be real, buying industrial servers or bakery ovens entirely out of pocket is a phenomenal way to instantly kill your cash flow.
Now, the massive upside to choosing debt is that it's strictly non-dilutive. You don't hand over a single percentage point of equity. When the company scales, the cap table remains entirely yours. Plus, as a nice bonus, the interest on that debt often acts as a highly efficient tax shield.
But, you've got to weigh those pros against the harsh realities of leverage. Mandatory monthly repayments can easily trigger a nasty liquidity crunch during a slow quarter. And furthermore, strict debt covenants and compounding interest can severely limit your operational flexibility if things don't go exactly to plan.
Which brings us to the other path. Section 3, Equity, Sharing Your Ownership.
This approach centers entirely on dilution. Instead of taking on monthly liabilities, equity financing means you're raising capital by selling a permanent percentage of your business to outside investors. They are basically taking a calculated risk on your vision, buying into the future upside of the company.
Typically, this capital comes from key strategic players. You have angel investors, who often inject high-risk seed money into early-stage ideas. Then you have venture capital firms. These are the institutional heavyweights that deploy large sums to scale high-growth startups. And sometimes it's simply business partners who bring their own capital to the table.
The really distinct advantage here is securing vital operating runway without the monthly cash burn of mandatory loan repayments. And beyond just the liquidity, bringing in institutional investors often means securing smart money. You gain immediate access to their network effects, industry experience, and high-powered strategic guidance.
But here is the trade-off, and it's a big one. Dilution is forever. You surrender equity, meaning you permanently share a slice of your future yields. And because these investors now own a piece of the pie, they're usually going to want a board seat, which means, you officially have a boss when it comes to major business decisions.
So this right here is the ultimate founder's dilemma, leverage versus dilution. Are you more comfortable keeping total ownership but bearing the strict burden of fixed liabilities? Or are you willing to optimize your immediate cash flow by surrendering a measure of absolute control and future wealth? It's a tough call.
Let's ground this with a real example. Section 4, Case Study, Sarah's Bakery.
Imagine this scenario. Sarah needs exactly $50,000 in initial CapEx and operating runway to secure her commercial lease, buy her equipment, and hire her starting staff.
So she faces two distinct options to secure that 50 grand. Option 1, she leverages debt from a bank. She owns 100% of the bakery, but she must repay that loan with interest every single month, absolutely no matter how many croissants she actually sells. Option 2, an equity investor funds the 50 grand for 30% ownership. Now she has zero loan payments to stress over, but her margins are permanently shared.
Think about what that 30% equity stake actually means. It means 30 cents of every single dollar of future profit leave the building to pay the investor. Forever. It's essentially a permanent tax on your own success. Over a 10-year horizon, that can end up being an incredibly expensive slice of the pot.
Now before we wrap, let's briefly hit Section 5, Alternative Funding Sources.
Because beyond just standard debt and equity, founders can tap into specialized government grants or maybe democratize the race through crowdfunding. There's also the friends and family round, which, let's be honest, often comes with its own unique emotional interest rates. Mature companies might rely on retained earnings or eventually tap the public markets by issuing corporate bonds and public stock offerings.
Finally, Section 6, choosing the right path.
Ultimately, business financing is the foundational fuel that allows companies to scale. The key takeaway for us here is that neither path is inherently superior. Really successful entrepreneurs focus on optimizing their capital stack based on their personal risk tolerance, their control preferences, and some very rigorous cash flow modeling.
As we wrap up this explainer, I want you to ask yourself, if you were launching your dream business tomorrow, how would you build your capital stack? Would you shoulder the leverage to maintain an empire of one, or would you dilute your equity to bring that smart money into the war room? Take a minute to really think about it. If you found this breakdown helpful, remember to like and subscribe for more deep dive insights. Keep learning.